Sorry about that. YouTube has just been kind of a nightmare over the last 2 days. So you have a look of someone not happy. Yeah, it's technical things that you have no control over are always difficult, but yeah, it's okay. Oh, hold on one second. Let's see if I can just share the link. Just bear with me for a second. Try that again. Yes, I am back. And to answer your question, Mr. Chap, about the interest rates of the banks. Yeah, they're going to put them up if the interest rates rise up. That depends on what the Bank of England does. So I would imagine interest rates will stay low for the unforeseeable future because the economy is in bad shape. So it needs to be supported, and low interest rates will support a bad economy. So I don't think you'll see any rise in the interest rates anytime soon. So yeah, hopefully that answers your question. It's a pretty dismal time at the moment for people saving money. Obviously, when interest rates are zero, some of the savings accounts are still paying 1%, which, who knows how long that will last for. Some of the banks are paying 0.25%. It's just a bad time. It's just a bad time. So yeah, I don't know. It's not a good time to be a money saver. I don't know why that link isn't working. Just bear with me for a second here. So if you have any questions, just pop them in the stream. Let's see. Yeah, Marcus is a good spot. They're paying 1.45% at the moment. That's pretty good. Marcus is decent. Ford Money has a decent interest rate. Oh, yeah, there's a couple of banks that are still paying decent money interest rate. So yeah, apologies about the technical difficulties. I will have it sorted next week. I don't know if it's my actual laptop, but I was having some issues with YouTube yesterday when I was doing some testing. But let me go through the sort of the news of what's going on with the peer-to-peer lending. And if you have questions, just pop them in. I'm going to do the stream for maybe another 15 minutes and then hop off here since I've embarrassed myself technically. Let me turn it that way. I did read the comments about the beard. Yeah, I was thinking about shaving it off too. And I know you were joking, but yeah, I don't know. It's the COVID beard. Apparently the beard can hold the virus too. So you got to be careful. Yeah, so Assets Capital, they're doing, there's obviously this payment holiday. They have also been approved to offer CBILS loans. They have a £100 million credit facility to be able to lend to businesses. I think they're asking for a lot more. The reason is that they need investor money to be coming in to lend out to businesses. Obviously, they're not getting the investor money in right now, so they're looking to the government to be able to have access to lines of credit to be able to offer to businesses. So you might see some of the same thing at Funding Circle, happen to assets. If you didn't read what I wrote, LendingWorks has taken some good actions towards what's going on with COVID. Their payment holidays until, I believe, July for borrowers. They're starting to increase the Shield Fund. It's gone up to 922,000. And what that's going to do, though, is decrease investors' interest rates. So you're going to see the growth. It used to be 5.2% target, has now dropped to 4.9%, and flexible from 4% down to 3.4%. That's a big drop. We'll talk about what, I don't know what that is in percentage, 15% lower. But I do like the fact that LendingWorks is being proactive, and they're saying that they've had 600 payment deferrals requests from borrowers, which is only 3% of their loan book, which is not a huge amount, but I think you might see more people deferring as the time goes on. Never blame the equipment operator error. No, it's all I have to take responsibility. Maybe it was my problem with the stream going down. Yeah, so let's see what else here. Rate setter, they've had a lot of demand from borrowers. They just don't have the investor money coming in to lend. So they're also looking for access to the government CBILS to be able to lend out. I don't know if they'll get that or not. It's an interesting one, that one. Haven't really seen anything new from Grove Street. You cannot move money out of there right now from the holding accounts, and you cannot change your investor settings, which is to prevent people mass exiting out of Grove Street. LoanPad's still looking good. They're increasing their lenders. There was 1,618 lenders in LoanPad last week. It's increased to 1,644 this week. They've got one defaulted loan and two loans that have extended, and their exit times are still good. You can still get out of there within a day if you want to. No problem with them. Their average loan to value right now is 29%, which is insanely low for a peer-to-peer lending company. So that's why I think LoanPad is a good place to put money. It's pretty safe. Again, make sure you diversify. Don't put too much money in any one company, because any one of these companies could have problems. I mean, same with any business, right? Look at what's happening with the airlines. You never know. So you always want to be careful and spread your money around. Let's see if you have any more comments. Brian says, looks as if the economy will begin getting going in the next few weeks. Do you think that peer-to-peer will get an uplift because of this? Yeah, I do, but I don't think that uplift is going to happen within a few weeks. I think it'll probably take 2 or 3 months before things really start to stabilize. And the reason is, you can look at what's happening in some of the Asian countries that are getting back to normal. They're opening up their economies, and McDonald's put out a report that was saying, despite 99% of all their restaurants being opened in China, that they're still not seeing that uplift yet, because people are still a little bit concerned about going out, even though their economy has been open for a while. And I think you're going to see that in first world countries like the UK and the US, where even if they announce the economy is open tomorrow, everything goes back to normal, people are still they're going to be used to staying home more. They're going to be a little bit concerned about their health more now. So I think it's going to be a slow return back to the economy. So peer-to-peer will also be more of a slow return back to normality. Yes, Chica, I will. I will consider about removing the bid for health reasons. Crazy Cash Paps is what I think of the house crowd. I have an investment in the house crowd that I put in about a year ago, so I'm sort of just waiting to see. I don't like their old business model of shares in houses because it just hasn't worked. I mean, Property Moose, it hasn't worked. Who else? British Pearl. I don't think it's worked really well for them. So Housecrowd does more development lending now, and they are doing their own development. So I'm sort of in a wait and see pattern over them. I want to see what happens to my investment that I put in a year. Was it? It's almost a year. It was in July of 2019. So I mean, I've been to the offices. I've met Fraser. Fun had a good conversation with him, but I'm not entirely sure about the house crowd. So trying to be a bit politically normal with my opinions on that because I don't want to say anything detrimental. The original business model, I don't know if it can really succeed. Nobody else has been able to make it work. So if they go straight into just developments and get rid of the whole buying shares in houses thing, maybe that will be better for them. But I invested in one of the developments, so I didn't put a huge amount in, but got some in there. Andy says, what are your thoughts on there being a index bubble? The best way to invest long term, is that the best way to invest long term? I do invest in them myself, but I'm waiting for it to pop. I mean, an index bubble would be just the stock market negatively downturning because all an index fund is doing is owning, all of those stocks in the market. I don't think there's going to be an index bubble. If you're asking me if there's going to be an index fund bubble problem, no, because people are just buying shares, in an index fund. It's, if there's an index bubble, there'll be a stock market bubble. I think it is absolutely the best way to invest long term. I actually liquidated an account for my mother last week. She had a professional financial advisor who had invested her through Brooks McDonald, and they put the money into my dad when he was still alive. It was 2013, and I was looking at the numbers, and the whole investment had returned 2%, and over 10 years. And the fees that had been taken out, it was a £60,000 fund, and there had been £2,700 of fees taken out of that account for professional advisement. So I absolutely think that index fund investing is the best long-term investment because it's brainless, right? You don't have to worry about trying to pick stocks or pick financial advisors. And all advisors is doing is putting you into a bucket of, managed unit trusts and taking fees from there. And your fees are resulting in your returns being lowered and lowered and lowered. So if you imagine that my mother's fund had made about £2,500 in gains, and the professional advisor had taken £2,700 in fees, take those fees out of there, and by the way, that's not including the unit trust fees. That's just for the advisor fees, which equates to, I think, 1% a year. So if you added that £2,700 back onto what she would have made, her fund would have been up almost £5,000. But because of the fees, she had made 2%. So this is why I'm so against actively managed funds with, financial advisors, because the fees just end up killing you in the long term. And if you do have any actively managed funds through advisors, go back and look at your fee history and start doing some math. Calculate how much actual fees you've been charged, and also do a comparison between what if you'd have put that money into an index tracker, what would your returns been like? And usually the returns are very similar, but the lower hand would be the actively managed. This would be your index trackers. And what you're going to see is, let's say you have an equity fund through somebody like Invesco, say the US, they're investing in the US, and this is your US index tracker. You'll see it just go like that on a chart. They're both going to do pretty much the same thing because these funds own what the index tracker funds own. They're just not buying the entire market. They're buying, picking and choosing maybe 20 or 30 shares. And they tend to correlate because they're usually buying Microsoft and Apple, and which make up a big portion of the indexes. But the actively managed one down here, the spread you're seeing here is between the fees that the actively managed one is charging and that you're losing. So the index tracker will most of the time beat this actively managed fund. I've done a lot of studies on this too. There's some articles on Financial Thing you can read if you really want to know. I hope that makes sense. I'm not always the best at articulating what I'm trying to say, but I have a good understanding of index funds. If you want to really learn more about it, read the book, The Little Book of Common Sense Investing, which I'll put in the chat here. Oh. Read that book. It's by John Bogle. It's got an amazing analysis of index trackers and why you'd want to use them. It's the guy that founded Vanguard. Let's see what else. Have I ever dabbled in Bitcoin? ACS. Yes, I have. I was actually a very small amount in Bitcoin. I just checked my account. I was lucky enough to buy some Bitcoin at $17,000, and I bought it's not Ethereum. It's I can never say it. It's the other big one, Litecoin, and the EUR one, which is one of the biggest coins, and they're all completely down. I mean, if you look at Bitcoin, it's just hugely volatile. It went from $19,000 down to $3,000. Now it's at $8,700. So it's a gamble. I looked at Bitcoin when it was $2 years and years ago. I don't think anybody really understands what Bitcoin is for and how it can be used. It's a complicated system to understand for most people. I think blockchain absolutely has a place in the finance world, but how it can be utilized in a more simple way is going to be the key. But I've had people tell me, Bitcoin is going to go to 100 grand. Yeah, could. Very volatile. It's a gamble. Don't put in too much money into Bitcoin. But some people have gotten massively rich from Bitcoin. But again, it's all about timing. If you bought, when I did 17,000, you lost a ton of money. If you bought down at 3,000, you can make a ton. How much are you willing to risk? Same with gold. Buy at the right time, you can make a lot of money. If you buy at the wrong time, you'll get very little returns. James says, how much do I invest in tracker funds versus peer-to-peer? I've got 6 figures in trackers and 5 figures in peer-to-peer. So, I do a percentage of my entire net worth, about 10 to 15% of my liquid net worth in peer-to-peer, much more in trackers. Good thing about trackers, likely never going to zero. The only way a tracker would ever go to zero, I think, is if, say, the US got invaded by China, and then it could go to zero, but unlikely considering that every American is armed to the teeth. So, yes, David, agree. There is a Funding Secure investor group on Facebook and a Lendy action group on Facebook. I recommend if you're an investor in either of those, join up. Funding Secure has a waterfall policy like Lendy, where they're going to get paid a portion of all the money that's coming in from the recovery of loans, which I think is criminal. So we'll see what happens. Banks seem to be making a lot of money. Mr. Smith says, yes, banks always have done very well because they have access to things that you and I don't have access to. David says, yeah, your mom was really done over. Yes, she was, because she didn't know any different. And I was somebody that didn't really want to get involved in trying to manage my family's money, even though I always thought the index trackers were the way to go. But I did a little test for my mother. I put some money in index funds a couple of years ago. I said, let's just watch and see how it does compared to your managed. And when I saw that the index funds were just outperforming the managed unit trust, I moved everything over. Do I think you should exit from Zopa? Miro, I'm not really a big fan of Zopa. I think for the returns you get, you're just not going to do very well over the long run. But I would just let your money come in and mature. I wouldn't pay their exit fees. Just take it out when you get your interest rate payments. I wouldn't reinvest in Zopa myself, no. I think it's too risky. The book Walk Down Wall Street. Yeah, I haven't read it. Thanks, David. I will take a look. Chica says, I would rather have a full Bitcoin than just a bit of one. It doesn't make any difference, though, whether you have a piece of a Bitcoin or a whole one. You still own a percentage. If you have the money to be buying full coins, then yeah, take a risk, but don't put too much money in. James says, I haven't invested with trackers yet. I've just used peer-to-peer so far. Yeah, trackers are just such a no-brainer. You're seeing absolute billions and billions of pounds and dollars going into trackers. You can do your research on the internet. There's tons of news stories about the inflow into trackers because investors are just wising up. They're getting smarter, and they're realizing that managed funds just don't tend to beat their benchmarks because the fund managers get it wrong. Look at Neil Woodford. He failed miserably. So, yeah, do some research and look at the index tracker situation. You're just going to see a lot more going into, oh, God, I'm sweating. You're going to see a lot more going into index funds, moving out of managed funds because people are realizing they don't want to pay these fees. Yeah, Chica, sorry, I didn't know you were joking. No, it's fine about the crass comments. I have a good sense of humor, Martin. Nothing really offends me. Unless I don't like racial, people that talk about races. But yeah. Andy, thanks for answering it on your website. Now loving your blog on index funds. Yes, index funds. Just they give me the warm and fuzzies. They really do. I just don't know why anybody wouldn't invest in index trackers unless you're a guru at investing. And there are some people that are technically really good with math and looking at charts. But for your average investor like me, I consider myself an average investor. I know how to read financial statements and whatnot, but I have no idea what companies are going to really survive and do well in the long term. I had some Apple shares. I actually sold them, most of them, because I just think that just peace of mind too, having that peace of mind to know I don't have to look at trying to buy and sell things. Once you're investing in an index tracker, you don't have to do anything else. You can just leave it until you need it. So yeah, I've been investing through index funds for. I had a little bit. So I think I bought in 2009, 2010. Before I really understood what they were. That was just pure blind luck that I happened to buy an index tracker. But I started buying through Fidelity in 2010, and then seriously through Vanguard in 2015. So yeah, it's been a while. And they've done really well. I mean, of course, they've dropped when the market has dropped, but so has everything. Well, most things have dropped. Do I invest in the U.S.? Oh, you do invest, Andy, in the U.S. Vanguard Fund and LS. 80%. So life strategy, that means the Vanguard has these things called life strategy funds where 80% means it's 80% equities, 20% bonds. They haven't as performed as well for me, the life strategy that I had them. I just ended up selling them, just buying my 2-fund strategy, US equity fund and the global bond fund. That's what I use, those two primarily. You're a bit nervous about getting involved, James. Yeah, you really, depends when you need the money, James. If you're 80 years old, probably index trackers, equities wouldn't be something I'd be too heavily invested in. But if you can leave the money alone for 5 years, I think if you invested in an index tracker right now, you'd probably be very happy in 5 to 10 years. So James, read that book that I put in the chat, Little Book of Common Sense Investing. It's a great book. Very simply breaks down, how index trackers track the markets. You own a bucket of thousands of stocks rather than trying to pick out individual stocks and shares. They receive dividends into them, or you can be paid out the dividend. They just make a lot of sense. The great thing about them is the fees are low. I'm paying 0.07% on one of my lowest trackers, and then my Vanguard 0.25%. That includes the platform fee and the fund fee. Low fees are the keys to everything. Go to a compound interest calculator and look at the calculations on, where would your account be in 10 years if it was 0.5% in returns lower or 1% lower in returns. You'll see these big differences, and those fees can make a big difference over a long period of time. Chika, you're very welcome. I'm glad you enjoyed it. Yeah, so that's it. I don't really have anything else to tell you, so next week I'll be back on Thursday evening at 8:15 p.m. UK time, and hopefully have these technical issues sorted out. Sorry about that. Apologies. I feel like a complete amateur, very embarrassed, but if there's any other questions before I go, David said in some ways index trackers are less risky than peer-to-peer. Yeah, for sure. I mean, like I said, your index tracker is very, very unlikely it would ever go to zero. With a peer-to-peer, you could lose all of your money. If you put all your money into one loan or one business and the loan defaulted or the business defaulted, then yes, you could theoretically lose all your money. In a tracker, you won't. So, I mean, imagine if the stock market went to absolute zero, you'd have a lot more problems in your index tracker. But yes, we will find out next week. Anyway, thank you all for tuning in. Please hit that like. Please hit the subscribe button. Join the Financial Thing community. Also, I'm going to be launching a Facebook group for Financial Thing readers, and which I will be checking more often. I can answer your questions on the Facebook group. I'll send out an email with the group information so you can join the Facebook group and we can have more discussions about peer-to-peer and investing. And the beard, I don't know. We'll see you next week. Maybe I'll show up without a beard. Guys, have an amazing week. Be safe, be healthy, and much love for tuning in. Take care.